The global semiconductor supply chain operates with microscopic precision, but its physical infrastructure is built at a massive industrial scale. Applied Materials provides the foundation for this hardware stack. They manufacture the machines that enable chip production. Their revenue serves as a direct measurement of what the industry is building, providing a data-driven alternative to market speculation. This chart shows Applied Materials' annual revenue over the past 6 years. Growth has been consistent, reaching a record $28.37 billion in fiscal 2025. But looking at the final quarter shows a break in that trend. Revenue dropped 3% year over year to $6.80 billion. The headline numbers mask an internal reallocation of how the industry is deploying its capital across technologies and regions. We track this restructuring through wafer fab equipment, or WFE, spend. Software roadmaps can change in an afternoon, but physical fabrication hardware requires years of planning and billions in deployment. Tracking where WFE capital flows identifies exactly where future technological capacity is being built. We are going to extract the internal data from AMAT's semiconductor systems segment and cross-reference it with their geographic revenue tables. These specific ledgers provide the data points necessary to validate the current demand for AI hardware. By following the capital flowing through Applied Materials, we can see where the next generation of global computing power is initiating. The machinery Applied Materials sells is directly tied to the specific architecture of the silicon wafers they manufacture. In fiscal 2025, the core machinery division, the semiconductor systems segment, generated $20.79 billion. This column chart compares segment distribution from the fourth quarter of 2024 to the fourth quarter of 2025. Over those 12 months, revenue from foundry and logic machinery shrank from 73% down to 65%. The offset shows DRAM memory equipment increasing its share from 23% to 29%, pushing upward as logic investment cooled. This surge in memory equipment is tied to high bandwidth memory, the architecture required to supply data to AI processors at high speeds. CEO Gary Dickerson noted that AMAT is positioning itself for volume production ramps in advanced packaging, the specific process used to stack these memory components. The bottleneck in hardware architecture has shifted from logic processors to memory, and WFE capital proves the industry is reallocating resources to solve it. As the technology profile shifts, the geographic map of where this equipment is shipped is also changing. AMAT's net revenue by geography table shows how regional capital is migrating. This map shows the decline in the Chinese market. Over the last fiscal year, China's share of total revenue fell from 37% to 30%, a drop from $10.11 billion to $8.52 billion. That accounts for a negative variance of $1.6 billion year over year. For the past several years, China imported machinery to build capacity in mature legacy semiconductor nodes. That build-out is now stabilizing as domestic capacity reaches saturation. The high-volume growth China once provided for legacy nodes has stalled, forcing capital to move into more advanced markets. This capital is migrating toward the regions capable of manufacturing the most advanced AI components. This Sankey diagram tracks the flow of global WFE spend. As the China pipeline narrows, the flow into Taiwan expands, jumping from 15% to 24% of total revenue. In the fourth quarter alone, Taiwan absorbed 27% of all Applied Materials revenue. South Korea is seeing a parallel surge in investment. Annual revenue from the region grew from $4.49 billion to $5.60 billion year over year. These geographic shifts align with the technology data. Taiwan holds the majority of advanced logic capacity, while South Korea leads the market for DRAM and high-bandwidth memory. The capital required to build AI hardware is centralizing into these two geographic choke points. Transitioning global infrastructure creates costs that are now appearing on the balance sheet. In the fourth quarter, AMAT recorded a $181 million restructuring charge. This charge is linked to a workforce reduction and cost structure optimization plan. Projecting the ledger forward on Q1 guidance, the trend line flatlines at $6.85 billion, indicating zero near-term growth. This tracks the physical latency gap transitioning to next-generation architectures. Operations are being optimized to support higher volume demand beginning in the second half of 2026. Fiscal 2026 is a bridge year. The company is absorbing restructuring costs and flat growth now to ensure capacity is ready for the next technological inflection. Applied Materials is defending its market position by increasing internal capital investment during this transition period. They are deploying record internal investments despite projecting flat immediate revenue. This chart plots flat revenue guidance against rising internal spending. The company allocated $3.57 billion to research and development and $2.26 billion to capital expenditures. That capital targets the manufacturing processes needed for the energy-efficient transistors scheduled for the late 2026 production ramp. AMAT is sacrificing near-term operating margins to secure its role in future node transitions. The fiscal 2025 earnings report shows the mechanics of a supply chain in transition. The quarterly contraction follows the shift from mature nodes to the next generation of advanced manufacturing. Capital leaves legacy manufacturing in China, centralizing in Taiwan for advanced logic and South Korea for memory. Ultimately, this data reveals a massively coordinated global relocation of specialized manufacturing hardware, deliberately engineered to meet the extreme requirements of future artificial intelligence. By sacrificing current margins for record R&D and restructuring its global footprint, Applied Materials is positioning itself as the primary tool provider for the production window opening in late 2026.